Hello, and welcome. I'm Brenda Pierce Davies, and we are so excited to be here and have you awesome people joining us tonight. Tonight, we are going to identify financial literacy, what it is, and why it's important. And after we answer those questions, we'll segue into credit. What is credit and why it is important? So, what exactly is financial literacy? For the last few years, we've been hearing those words floating around a lot, but did it register with us exactly what it is? Well, financial literacy is understanding the concept of saving, investing, and debt. All of this that lead to an overall sense of financial well-being and self-trust. So, how can we acquire financial literacy? Well, it's simple. It starts by building basic knowledge of money matters. Question. So how do you think the United States fare in this area? How do Americans add up when it comes to having the basic knowledge of money matters? Well, according to TIAA, Institute Global Financial Literacy in 2020, Americans needed to improve dramatically. After being tested in this arena, respondents answered an average of just 52% of personal finance questions correctly. Friends, we scored an F. We are failing. But having this knowledge, it really helps us understand why there's 61 million Americans with bad to low credit scores between 350 to 649, and why 24 million have no credit file at all, and 118 million have no idea how to get a copy of their credit report. And this is frightening because of how heavy credit impacts our lives. Now, all the aforementioned escalate the need for credit repair. You may say, well, I don't have time to read. Well, ask yourself exactly what is this not taking this 5 to 10 minutes a day to educate myself on financial literacy going to cost me in the near future? Let me give you a quick example. Now, here's John, who is financially literate, and Jane, who is not. They both decide to purchase this Toyota Camry at the price tag of $23,000. John has a credit score of 730. He received a low interest rate of 1.99 and a monthly payment of $368.22. His total interest was $1,302.39. Grand total for the payment of his vehicle, $24,302.39. Now here's Jane on the other hand. Her credit score was 599. Her interest rate was a whopping 14.99%. Her payment was $513.97. Total interest, $10,921.44. Grand total payment for her vehicle, $33,921.44. The price of bad credit due to lack of financial literacy cost Jane a whopping $9,619.05. What a high price to pay. Now, with that being said, let me ask you this question. Are you financially literate? So, what is the goal of financial literacy? Well, the goal of financial literacy is to establish control over your finance while also using money as a tool to freely make choices that build greater life satisfaction. Question. Is this you? Additional goals include the ability to navigate unexpected issues like if you lost your job, will you be able to set and work toward financial goals still? When you're financially literate, you understand how to allocate your income toward various goals at the same time or simultaneously. Not just the ongoing expenses, but savings, debt, repayment, and have an emergency fund too. You'll know how to access tools to thoroughly research and evaluate loans, credit card, investment opportunities. So even if you don't have a lot of disposable or extra income to help you reach all your financial goals, financial literacy will help you to know how to prioritize them and make strides when you're able to. So, what does financial literacy look like? How does it look in action? Well, here we go. Increasing your retirement saving rate every time you get a raise, meaning whenever you get a raise, you're going to increase the amount that you place into your retirement along with that. You're going to maintain 3 to 6 months worth of expenses in emergency fund and replenish it after you have withdrawn money from the account. Comparing promotional periods on balance transfer cards so you'll have an extended time to pay off that debt. And checking your credit report regularly. Question, is this you? Let's continue. Why is financial literacy important? Well, a financial literate individual, they not only manage money with more confidence, but they also have a better chance of handling the sure to come ups and downs of our financial life. They understand how to prevent and how to manage issues as they arise. Meaning, you're going to have to keep a close eye on your bank and credit cards account so you're aware of potential fraud as soon as possible. Or being able to recover from a costly, unexpected car repair quickly. You know what I mean. But thanks to that ample cash saving that you have, you're ready for it. On the other hand, financial literacy can help individuals save diligently for things like things they really care about, like vacation, or perhaps their child's college education. So, what are some ways financial literacy can affect other aspects of our lives? Well, first of all, you need to understand how much you earn and spend. When building financial literacy, making a budget is one of the most important ways to establish a true understanding of your income and expenses. Once you have a budget, you can continue to track and spend. And you want to revisit your spending plan regularly. Repay and avoid debt. Seeking out the lowest interest rate when comparing loan terms, this can save you a substantial amount of money, as we've seen in John's case. Another thing is paying off credit card balances each month, so you don't have to worry about paying all of that extra interest charge. Now, if you already have debt, financial literacy can help you choose the best method to get out of debt. Either you can do this on your own or with the help of a qualified expert. Financial literacy, it protects yourself from debt and bankruptcy. We have seen a lot of bankruptcy lately, and we know a lot of this is due to lack of financial literacy. A crucial way to prevent debt from building is to create an emergency savings fund, as I mentioned earlier. A financially literate saver knows how much to set aside. And we said ideally anywhere from 3 to 6 months worth of expenses. And you want to aim to keep this at that level at all times. And then you work toward a secure retirement, whether it be a short term plan or saving for retirement, long term retirement at the same time. Now, when you become financially literate, you'll have a better idea of how much to save, what type of retirement you want, and how to get there. Financial literacy affects many areas of life, including savings and investing. If you can also, if you have, it can also have this big impact on how you manage your debt and how you borrow. So definitely, we want to be financially literate because these are some of the two of the biggest things that we end up doing. We are either borrowing money or in debt. So listen, friend, financially literate individuals are more likely to accumulate wealth. Who doesn't want that? And they can do this due to their more confident. They're more confident with the decision that they make and the investment that they make. So people with higher financial literacy scores, they have a better retirement plan and are better able to do the math, meaning they're able to put together a realistic view of their finances. Guys, you're going to face some issues even if you're financially literate. But can you begin to wrap your mind around the potential damage if you're not? While mortgage debt accounts for basically $9 trillion of total consumer debt in the United States, Auto loans, credit cards, and student loan weigh heavily on the American consumer. Now, according to the Federal Reserve Bank of New York, about 40% of Americans spend up to half of their income on debt. Wow, half of their income. Now, see, that's not including your utilities, your rent, your daycare costs, food, gas, etc. As you can see, financial literacy focuses on understanding the money, time spent paying off debt, how to manage these payments, and avoid being in debt. By understanding the basics of finances, you can be more prepared for obstacles that come along the way. Financial literacy includes knowing where to turn for help and when you need it. Now, whether you're looking to make a mortgage payment, purchase a home, a vehicle, invest, or just saving for a rainy day, if you're financially literate, you'll know exactly where to go. By understanding how your finances work and how to save for them, you can create a secure future and enjoy living without all of this worrying. You'll then be able to build a good nest egg and give generously to those you care about. How about that? Now, financial literacy and credit, they work together, for better or for worse. Meaning, if you're financially literate, you're most likely to have a great credit score. That's the better. If you're not financially literate, you're most likely you'll have that poor credit score. And that's the worst. So we've defined and dissected financial literacy. Now let's attack credit. What exactly is credit? Well, credit is the ability of a customer to obtain good or service before payment, based on the trust that payment will be made in the future. It also means credit is defined as agreement between a lender and the individual who borrows. Or credit also refers to an individual or business credit worthiness or credit history, or the ability to borrow money or access good or service with the understanding that you're going to pay it back later. Now, why is credit important? Well, let me run down just a few reasons. Better approval rate. You'll be approved at a better rate. If you have a good credit score, you're more likely to be approved for credit and credit products like credit cards and loans. And then there's lower interest rate. As you've seen in John's case, the higher your credit score, the lower your interest rate you'll qualify for. Get better rates on car insurance. Save on other type of insurances. Get approved for higher credit limit. Have more housing options. Now, then you'll be able to choose where you want to live as opposed to your credit score dictating where you live. You get utility service more easily. You get cell phone without prepaying or making a security deposit. Then, guys, you just look better to potential employers. It's very important that you know and understand financial literacy and credit before you attempt any credit repair. To skip this education and go into credit restoration, guys, it's like putting a band-aid on a person with the flu. It's not going to do any good. If you're financially educated, you will skip all the many pitfalls that cause an individual to have to return to credit repair. That's why I take pride in financial education before credit restoration. And remember, your credit health equates to your monetary wealth. Now, if you have any question for me, please drop your question in the comment section and we'll get you some answers, and not just answers to those, but all the other questions you may have. We have a wealth of knowledge located on this page, which is um, credit restoration and financial literacy page, and we invite you to go there. So next we have up Miss Leandra Turner, and she will be speaking on credit score and how it's calculated. Miss Turner, the platform is yours.
Thank you, Ms. Brenda Pierce Davies, for the introduction. Like she stated, my name is Leandra Turner. In this segment, we will now talk about what is a credit score and how it is calculated. What is a credit score? A credit score is a number that ranges between 300 and 850 that represents a person's credit worthiness and is derived from a credit report. The higher the score, the better you look to potential lenders. A credit score is based on credit history, which consists of the number of open accounts, total levels of debt, repayment history, and other factors. Lenders use credit scores to evaluate the chance that an individual, such as yourself, will repay loans in a timely manner. You may have noticed that you have 1, 2, or 3 different credit scores from the credit bureaus. Sometimes one credit bureau might give you a different credit score than the other bureaus. For instance, if you make a large purchase that uses a large percentage of your available credit, your score is likely to drop until you pay off your high balance, but it might drop more quickly with one credit bureau than with the other two. Why, you might ask? The reason being is because each credit bureau is continually adding new information to your credit file, but the 3 credit bureaus don't always receive the same information at the same time. Now, how is your credit score broken down? Well, your score is broken down into 5 categories. Majority of your score comes from your payment history, which makes up 35% of your score. Payment history is the record of all your past payments and whether they were paid on time or late. It can also include missing payments if no payment was ever made. Your payment history typically includes payments for all your credit cards, installment loans, retail accounts, and home mortgage loans. So now's the time to ask yourself these questions. Do you make payments on time? How often do you miss payments? How many days past the due date do you pay your bills? How recently have your payments been missed? And how far behind are you on a bill payment? The number of accounts that show late payments and whether you brought the accounts current or not are all factors. So you may be wondering what happens if you miss a credit card payment by 1 day. Does it even affect your score? Fortunately, most lenders also provide a 29-day grace period after the payment's due date before reporting the payment as late to the credit bureaus. If you make your payment during this grace period, your payment will be reported as on time, the same as if you made it on or before the due date. But what if it's past the grace period? You may wonder how badly does it affect your score. According to FICO's credit damage data, one single recent late payment can cause your credit score to drop by as much as 180 points. This is because a late payment is a red flag to lenders that you may be experiencing trouble repaying your debts, making you a more high risk to lend to and a greater credit risk, which increases the lender's risk of losing money by lending to you. So how to have a good payment history? Well, it's easier said than done, but it's paying on time. This may seem obvious, but the key to a solid payment history is paying your bills on time every month without fail. Late payments in your past can't be taken back, but their effect will diminish with time. So if you move ahead without any new missteps, your credit score will tend to improve. The next category is the amounts owed, which makes up 30% of your score. So how much of the credit that you are allowed that you use? If you exceed the limit, you are seen as a high risk and penalized. If you use less than 30% of your credit limit on each credit card or line of credit, you are considered credit worthy and get a positive rating. Next, we have the length of credit history, which makes up 15% of your score, or how long you've been using credit. So what is considered a short credit history? Well, that's anything less than 2 years. And what is considered a good length of credit history? You may think that it's anything more than 2 years, but it's actually 7 years that is deemed a reasonable amount of time to establish a good credit history. The longer your history of making timely payments, the higher your score will be. Credit bureaus generally look at the average age of your credit when factoring in credit history. Therefore, you should consider keeping your accounts open and active. It may seem wise to avoid applying for credit and carrying debt, but it can hurt your score if lenders have no credit history to review. Then we have 10% that comes from the new credit or new credit inquiries. And new credit is exactly what it sounds like. Credit lines or loans that you apply for that you did not have before. It normally counts the number of inquiries and new accounts that have been opened in the last 12 to 18 months. It's okay to occasionally open a new account, but if you are applying for several accounts in a short period of time, the creditors will view you as a risk and your score will take a hit. When you apply for new credit, inquiries remain on your credit report for 2 years. And the last category is the types of credit used or credit mix, which is 10% of your score. There are two main types of credit: installment loans and revolving credit. They can include a mix of accounts from credit cards, retail accounts, installment loans, and mortgage loans. FICO prefers a mix between credit cards, mortgages, and auto loans, but that's only if you can afford them. Now, even though a good credit mix can help your credit score, does that mean you should start applying for every single type of credit line you don't currently have? Well, the answer is no, because two things will happen when you apply for multiple new credit lines within a short period of time. The first thing that will happen when applying for new credit is that creditors will check your credit, which will give you a hard inquiry, which results in lowering your credit score, and it remains on your credit report for 2 years, but will only take effect on your score for the first year. And secondly, if a creditor sees you've opened many new accounts within a small time frame, whether it be true or not, it could come across to them that you are experiencing financial distress. So if you apply for a loan, the likely result will be a denial of that loan. Now, what are the key takeaways from this educational session? The first thing is the higher your rate of on-time payments, the higher your score will be. Every time you miss a payment, you negatively impact your score. Secondly, high balances and maxed out credit cards will lower your credit score, but smaller balances can raise it if paid on time. The longer your history of making timely payments, the higher your score will be. Fourthly, you can occasionally open a new account, but don't apply for several accounts in a short period of time. The creditors will view you as a risk and your score will take a hit. And lastly, FICO prefers a mix between credit cards, mortgages, and auto loans, but that's only if you can afford them. So thank you all for your undivided attention. Now we will have Ms. Raven Bethune speak about what is bad, slow, low, and no credit, and what can you do about it.
Alrighty. I appreciate that introduction, Deleandra. Hello, everyone. As Deleandra stated, my name is Raven Bethune. The topic that I'll be touching on for this educational lesson on tonight is what is bad, slow, low, or no credit, and what you can do about it. We just discussed what a credit score is and how it is calculated. So let's jump into the general breakdown of a bad credit score, a slow credit score, a low credit score, and no credit score. According to FICO, a person with a credit score that falls below 580 is poor. Of course, there are levels to everything, So there's levels to bad credit. A bad credit score consists of a 300 to 400. A slow credit score consists of a 500 to 579. A low credit score consists of a 580 to 619. And we'll get to the no credit here in just a moment. The bad credit score has limited credit card choices, meaning you won't be able to get that black card that Usher be talking about in his song, No Limit. The bad credit score has less favorable loan terms as well. The slow credit score, it allows you to get loans, but you will have a high interest rate. Lexington law states that if you get a credit card with a 525 score, you can expect an average interest rate of 21%. That's really high. A low credit score allows you to get an FHA loan, which is simply a Federal Housing Administration loan, which is a government-backed mortgage loan that can allow you to buy your home with looser financial requirements. So you see, the low credit score, it opened up more opportunities compared to the others. Let's move right on into what is no credit. How many of you understand the phrase no credit? When it comes to no credit, it simply means that you've never opened a credit account, like a loan or credit card. You don't have a consumer credit report, and the only way you can have one is if you borrow money from a financial institution, like a bank, or get a credit card. Then, of course, this is where your credit history will begin. So after stating all of that, what can you do about it? How many of you have tried to fix your bad credit and was successful? If you were successful, you did the following. You checked your credit score, you paid your bills on time, you paid down your debt, you avoided new hard inquiries, and also you got help building your credit. Why is it important to check your credit score? Well, we check our credit scores because it tells us what's, helping our score, such as no missed payments or no collections or public record. And then it tells us what's hurting our score, such as high credit usage or short account history. Checking your credit score as well as your credit history can help you better understand your current credit position. Regularly checking your credit reports can help you be more aware of what lenders may see. Another importance of checking your credit score is checking for any errors, such as inaccurate personal information or accounts fraudulently opening your name. Dispute this type of information with the credit bureaus. Tip number 1, please visit consumer.ftc.gov/articles/free-credit-reports. The federal law gives you the right to get a free copy of your credit report every 12 months. However, as of right now, through December 2022, everyone in the U.S. can get a free credit report each week from all 3 national credit bureaus at annualcreditreport.com. So that's Equifax, Experian, and TransUnion. Friends, family, a lot of us have loved ones that have taken advantage of us in situations where they use our credit for themselves. So please make sure you complete this step to make sure there's no fraudulent accounts open in your name. Next, why is it important to pay your bills on time? Your payment history accounts for 35% of your credit score, just as Daleandra stated. Paying your bills on time is an important aspect of taking control of your financial life. Knowing when your bills are due and making a habit of paying them by the deadline can reduce your stress, save you money, boost your credit score, and enable you to get lower interest credit in the future. Tip number 2, auto pay. I love the auto pay function myself. How many of you use auto pay? Auto pay ensures you are never late for recurring bills such as your car payment or your credit card bill. Moving forward, why is it important to pay your debt down? Your amounts owed is the next factor that takes up 30% of your credit score. Experts recommend using no more than 30% of your credit limit at any point, and this is also known as your credit utilization. How many of you have a hard time paying that debt down? Here's another quick tip. A balance transfer credit card may be a better option because it provides an interest-free period that lets you pay off your balances without adding additional charges over time. This is particularly helpful if you have high interest credit card debt. It can help improve your credit score. Once your debt is paid, you can focus fully on saving and other financial goals. Getting rid of debt can remove an emotional as well as a mental burden. Too much debt, especially credit card debt, can have a negative impact on your credit score. When your credit card balances are high compared with your credit limit, your credit score takes a hit. The same thing applies when your loan balances are high compared to the original borrowed amount. Being debt-free has the additional benefit of helping raise your credit score. Now, why is it important to avoid hard new inquiries? Anyone familiar with this term? I'm sure many of us are. I'm sure at the beginning of this year as well, when we got that taxes, the refund of it, many of us went to the car dealership. A hard inquiry happens when a lender checks your credit to determine the potential you will repay the debt. When a lender or a company requests to review your credit report as part of the loan application process, that request is recorded on your credit report as a hard inquiry, and it usually will impact your credit score. It tends to have a greater impact on the credit scores of people with a short credit history or a few credit accounts. This means that for those just starting to build their credit, a hard inquiry can knock off more points from your credit score than it would for someone who has a longer credit history. Soft inquiries are those that don't affect your credit score, such as when you check your own credit score. Tip number 4. If you're looking to buy a car, just as I stated earlier, please don't allow multiple car dealerships to check your credit, because each time they do this, you are losing around 5 to 10 points per dealership. Moving forward to why is it important to getting help building your credit? Building credit takes time, and it doesn't happen overnight. However, if you keep your account balances low and pay on time consistently every month, you'll be on your way to attaining the credit you need to achieve the financial goals you are setting for yourself. So let's start by becoming an authorized or approved user under family or friend that doesn't mind helping you start your journey of credit building. Usually this stage is for teenagers who may only have a cell phone bill, so that will start their credit history. And by them making those payments on time, they have already set their foot for success. Once you have started building some credit history, you can apply for a secured card, such as a Capital One Platinum secured card. And also, ladies and gentlemen, understand that once you have started building and restoring your credit, here are some following results behind this that Miss Brenda stated earlier. You get better approval rates. You're more likely to be approved for credit products like a credit card or a loan. Lenders will look more favorably on someone with a 760 credit score versus a 550 credit score. You get better terms. It helps you qualify for the best terms on basically every kind of credit product. You may receive a higher credit limit on a credit card or a larger loan amount on a mortgage. You may even from longer terms on your loan, such as a 30-year repayment period versus a 20-year one. Typically, benefits such as these are rewarded to those who have good or excellent credit score. The best credit cards offer annual credits on dining and travel, high reward rates, lounge access, and much more. While there are reward credit cards for people with, bad or fair, maybe average credit, you'll often miss out on the best of the amazing benefits that they have to offer. Next, you get utility services more easily. Your credit may also be considered when you set up accounts for utilities like electricity or internet. Good credit can mean that the utility company may not require a security deposit. I am in for that. I hope you are too. Now, I thank you all for your attention, and I want you to now focus your attention on whether you should restore your credit yourself or let a specialist do it. So, without further ado, here is LaKayla Bethune to educate you on this aspect.
Hello, thank you. Thank you, Raven, for that wonderful introduction. We learned about what is credit and financial literacy and why is that important. Second, we went over how what is the credit score and how it's calculated. Third, we just went over what is bad, low, or slow credit and what can we do about it. So we're going to get right into what is our last topic. Let me get to it. Which one is more effective? Is it the credit repair specialist or is it the do-it-yourself route? Is it my whole screen showing? It is. Okay. Give me 1 second. Okay, how about now?
You're
Okay.
fine.
All right. So now, as I stated, which is better, the credit repair specialist or the do-it-yourself route? And this is a common question that is asked on a regular. When you bring up this topic, people might say that the do-it-yourself route is the best way to go. But we're here to find out, is that question a fact? For those who don't know, do-it-yourself credit repair includes a set of steps you can take on your own to improve your own credit score. But most don't think it through thoroughly as to what all is needed. So I want to take the time out to ask you questions that you need to take into consideration before you start the process, so you don't waste time nor money. The first question I would like to ask, do you have the knowledge, whether it's of your consumer rights, credit, or credit repair laws? Do you have time? Do you know the process? Do you know what should be included in your letters? If not, you can prolong the process by trial and error. The positive that the do-it-yourself route can offer you is, of course, the first thing that comes to mind is the cost. It's totally free, especially when you don't factor in the cost of paper, ink, envelopes, stamps, gas, and of course your time. The second positive will be the education. Just like the credit repair specialist, you'll learn the ins and outs of the consumer finance while dealing with the credit bureaus. Now, the negative is the process and time. It can be quite tiresome and boring, and because you're more than likely not an expert in this field, it may take time to figure out what's needed to repair your credit or the type of letters you need to write. The second would be the opportunity cost. You could be doing something else to earn extra money for you and your family while you're spending time dealing with the credit issues. Or you could be spending time with friends or just simply take out the time for yourself. Have a staycation or a relaxation day. Now, a credit repair specialist is to help individuals to improve their credit scores and educate themselves on the individual's credit reports in order to be able to help the best way they can. And a few of their tasks include identifying the appropriate consumer protection laws for your situation, contact the appropriate creditor or credit bureau to notify them of the issue, performing follow-up actions depending on the responses received, tracking correspondence and paperwork, and visiting a notary public if documents require authentication. And the pros and positive that the specialists have to offer is one, dealing with financial problems lead to stress. So with a respectable credit repair service company working for you, financial difficulties are solved. Two, it's a stress-free process. They will contact your creditor for negotiating settlements, deleting inaccurate information, and update your account status. They will report to the credit bureau to ensure your credit report has the positive changes made. Three, credit repair companies offer the following services: the credit report review, preparing letters to credit bureaus, contacting collection agencies, disputing negative items, negotiating payoffs, and recommending to you other actions that are needed. Four, don't forget that you're gaining the benefit of years of experience. Specialists know how to help you get the best possible results without you having to go through the painful experience of trial and error. Five, they are experts in credit law. They know individuals are protected from unfair credit reporting, billing, and collection practices by federal law. If you're not well versed in any of the laws, don't worry. The specialists are going to be there to help guide you along the way. Remember that credit reporting agencies and your creditors are not anxious to take off anything of your report, and they even may reply with a hard no when you ask them to have an item removed. If you're not fully aware of your rights, do not know how to respond, or if you simply fail to follow up properly, then you risk wasting your time and seeing little to no positive results. 6, they're skilled negotiators. They work with banks, lending institutions, credit card companies, collection agencies, and credit reporting agencies every day. They know how to communicate with these professionals and how to negotiate beneficial agreements. They'll be able to negotiate a debt interest rate and terms and a discount payoff. They'll get you your payments lowered, having a debt dismissed, stopping collection actions. 7, you'll have access to their expert advice and support until your issues are resolved. The process of repairing your credit is not always fast, so it can take several rounds of negotiation to agree. Once the credit bureau is notified of any change to your credit history, it is required to update your credit report within 30 days. Your credit repair specialist will be there to help you if you have any questions. Last but not least is your time. Now, this was a negative for the do-it-yourself route, but for the specialist is a positive and we all know that this process involves specialized knowledge and takes too much time. So the specialist is there to help you to save time so you can spend your day the way you want. Now, the flip side of it, the negative, could be the cost when it comes to a specialist, where you don't really have to pay anything when you do it, the do-it-yourself route, because we all know that it requires a payment. But even with the fees associated with hiring someone to fix your credit, it's more likely that a professional can fix the problem more quickly than you on your own. And remember, you're paying the company for their knowledge and efficiency that they bring to the table. The second negative can be that some companies and or specialists can be scammers, and some can also be untrustworthy. You know, some they'll tell you whatever you want to hear just to receive a paycheck. And if you're anything like me, then I know for sure you don't want others playing with your hard-earned money. We want to have enough knowledge about a specialist or a company So we'll be able to select one that cares about us as an individual and that actually get us the results. And remember, but I also want you to remember at the same time that they're not miracle workers. It takes time, but you should be seeing results in about 2 to 6 months, depending on what's on your credit report. The third and final negative can be that even average people or average Joes now have a credit repair company. 90% of small companies don't understand the credit consumer laws, or the FCRA, which is short for Fair Credit Reporting Act, which dictate whether it can be removed or not by law. They just know the letters that can be sent in, but not know how to leverage them to their maximum potential. So the key points I want you to take away from this lesson today is the first and foremost, that ultimately that the decision to hire someone to repair your credit or to do it yourself belongs to you. 2, you might be successful with your own DIY credit repair plan, but like so many individuals, you also might strike out or simply be too busy to follow through with the process on your own. So don't underestimate the time commitment, which can be involved with the DIY approach. 3, credit repair specialists. Even though there are fees associated with them, the financial benefits you will receive by achieving better credit generally outweigh the cost of credit repair many, many times over. But at the same time, be careful of the untrustworthy companies and the average Joes. 4, no matter which route you take, it takes time to get things and or items removed from your report, because the credit reporting agencies, like I stated before, are not anxious to take anything off your report. So they'll tell you no whenever you ask for an item to be removed. But it extends the process and your time if you're not fully aware of your rights, if you do not know how to respond, or if you simply fail to follow up properly, because then you'll see little to no positive results. So I would like to thank you all for your time and undivided attention. I really do appreciate it. I hope you all receive valuable information that will help you reach a conclusion on what's best for you. If you want to learn more about credit, then you can go to our Facebook page called Credit Repair and Financial Literacy Education. If there's any questions about what we talked about today, especially my topic, please reach out and inbox me on my personal Facebook page that's on the title that's showing now, on the slide that's showing now. I hope everyone have a good day. So now I'll turn it right back over to Mrs. Brenda Pierce Davies.
Thank you so much, Kayla, for that fine lesson that you just gave us. I want to thank all of you also for showing up tonight to receive this financial education course. And we look forward to seeing you on our next event. So remember that restoring credit via financial education and creating financial wealth and legacy for family is our goal, every family we come in contact with. So I want to thank you all so much for your attention. And for all of you that stayed with us through the full course of this, I have a credit secret for you. And this secret has been proven to increase your credit score every month. So drop your name and email in the comment section, and I'll make sure that you get the secret and instruction. So remember that your credit health equates to your monetary wealth. Good wealth to you, and good night.